Hi everyone, I hope you're all doing wonderful today. I'm the Portfolio Panda, understanding franking credits in Australia. There is a lot of misunderstanding behind franking credits. There's a movement of people that want to remove them entirely. In this video, we'll explore the concept of franking credits, how they work, and who benefits from them. So let's dive right in. Franking credits are tax credits associated with Australian shares. They represent taxes already paid by a company on its profits generated within Australia and subject to Australian company tax. These credits serve to prevent double taxation, ensuring that shareholders are not taxed twice on the same income. When someone tells you we should abolish franking credits, keep this in mind. Imagine you own shares in Telstra, a company that generates all its profits in Australia. Telstra pays Australian company tax on its earnings. As a shareholder, you're entitled to a portion of those profits in the form of dividends. Alongside these dividends, you receive franking credits. These credits are not cash payments but are used when you file your taxes. They signify that the company has already paid a 30% tax on the profit being shared with you as dividends. Without franking credits, this income would be subjected to double taxation, once at the company level and again when you receive the dividends. The primary advantage of franking credits is that they help reduce your tax liability. By applying these credits, you can offset the tax you would otherwise owe. For instance, if your personal tax rate is lower than the 30% tax rate already paid by the company, you may even receive a refund for any excess franking credits. This refund feature is particularly attractive to retirees who often fall under a 0% tax rate. So, for individuals with no tax liability, each dollar of a fully franked dividend can effectively be worth $1.43 after accounting for the franking credit refund. Franking credits also benefit superannuation funds. During the accumulation phase, these funds pay a 15% tax rate, and in the pension phase, they pay no tax at all. Any excess franking credits received beyond their applicable tax rate serve as an additional dividend, enhancing the overall returns for the funds. An interesting consequence of franking credits is their influence on dividend policies of Australian companies. Compared to countries where this provision does not exist, Australian companies tend to be more generous in their dividend payments. On average, Australian companies distribute around 4% dividends, while US companies, for example, distribute only about 2%. Instead of dividends, US companies often choose to buy back shares with their profits, benefiting the remaining shareholders by increasing the value of their holdings and avoiding double taxation. If you're eligible to receive franking credits, applying for them is a straightforward process. Step 1. Check eligibility. Before applying for franking credits, it's important to ensure that you meet the eligibility criteria. To be eligible, you must be an Australian resident for tax purposes and hold shares in Australian companies that offer franked dividends. It's also crucial to have a tax file number and lodge an income tax return. Step 2. Obtain dividend statements. To apply for franking credits, you'll need dividend statements from the companies in which you hold shares. These statements provide detailed information about the dividends received, including the franking credit amounts associated with each dividend payment. Dividend statements are typically issued by the company's registry or your stockbroker. Step 3. Prepare your income tax return. When lodging your income tax return, you'll need to include the franking credits you're entitled to. If you're lodging your tax return online, ensure that you have the necessary documentation, including the dividend statements and any other supporting documents related to your investments. Step 4. Complete the relevant sections. Within your income tax return, you'll find specific sections dedicated to reporting franking credits. The exact location may vary depending on the tax return form you're using, such as the individual tax return or the tax return for trusts and partnerships. Step 5. Declare franking credits. In the designated section, you'll need to declare the total amount of franking credits you're claiming. This information is typically found under the credits or offsets section of the tax return form. Ensure that you accurately enter the franking credit amounts from your dividend statements. Step 6. Lodge your tax return. Once you've completed all the necessary sections, review your tax return for accuracy and completeness. Double check that you've included all relevant franking credits and supporting documentation. When you're satisfied, submit your tax return to the Australian Taxation Office by the specified deadline. Additional tips: keep copies of all dividend statements, tax returns, and relevant documents for your records. If you're unsure about any aspect of applying for franking credits, consult a tax professional or contact the ATO for guidance. While franking credits offer tax advantages for most investors, individuals on the highest marginal tax rate may find a slightly better outcome by generating returns through capital gains. This is due to the 50% capital gains tax discount applicable when holding an asset for over a year. To summarize, franking credits in Australia provide tax benefits to shareholders and influence dividend policies of Australian companies. They help shareholders avoid double taxation and reduce their tax liability, while also benefiting superannuation funds. The presence of franking credits encourages more generous dividend distributions by Australian companies compared to their overseas counterparts. By understanding the intricacies of franking credits, you can make informed investment decisions and capitalise on the tax advantages they provide within the Australian investment landscape. As usual, let me know any questions in the comments below, and make sure to share this with your least financially savvy friend, then tell me if I did okay in explaining the topic. Your most valuable asset is your time. Thank you for sharing yours with me. Until next time.